So welcome everyone. I'm happy to introduce Franziska Arnold-Dwyer. She is an associate professor of law at the University of College London, where she writes and teaches about insurance, among other things. She's the author of several books on insurance, including Insurable Interest and the Law, published in 2020, and in 2024, Insurance, Climate Change and the Law. Today, she's going to be presenting us some work in that vein, and we recommended as background reading for that an article that she published in our very own Connecticut Insurance Law Journal. And before I hand it over to her, I'll just advertise our next session and final session of the semester. Chaim Simon presenting in 2 weeks on whether insurance contracts are contracts. So, fun topic. So with that, I'll hand it over to Franziska. Thank you for coming.
Thank you very much, Travis and Peter, for inviting me. It's a real privilege to be here this evening. I'm dialing in from London, and I've been an avid follower of the series for a while. So it feels very special to presenting here today. So now to the most difficult thing, which is sharing my slides. I hope I can manage. Just 1 second. Here we go. All right. So the topic of my presentation is how we can leverage insurance contracts for climate action. And sorry, here we go. It's pictures like these that we are seeing in the news almost every day. And of course, the US was only recently hit by 2 hurricanes, Helene and Milton, causing windstorm and flooding damage to many homes and businesses. And in Europe too, we have seen weather extremes. The picture here on the right is from the south of Spain in Valencia, recently hit by extreme rainfalls causing flooding. And in summer, there were extensive wildfires in Greece and Portugal. So the Intergovernmental Panel on Climate Change has said that it is unequivocal that it is human activities, principally through greenhouse gas emissions, that have caused global warming. And the current trajectory is that we are on for 2.5 degrees warming of the global surface temperature by the end of the century. And climate change is already affecting many weather and climate extremes in every region across the globe. I was just looking for some numbers earlier, and I found the following statistics from ClimateGov for the US. In 2023, the US experienced 28 separate weather and climate disasters, costing at least $1 billion. And 2023 was also deadly, causing almost 500 fatalities. And that's the 8th most disaster-related fatalities for the contiguous US since the 1980s. So just to give you some political background to climate action. So here the baseline or the most important document is the Paris Agreement 2015. Very importantly, in the preamble, it says that climate change is a common concern of humankind, so it's something that affects everyone. And the Paris Agreement sets 3 important goals. The first one is to try and reduce global greenhouse gas emissions so that we can limit the temperature increase to 1.5 degrees. We're already broken through this, or at least to 2 degrees above pre-industrial levels. Then the second goal is climate adaptation. This is to increase our ability to deal and adapt to the adverse impacts of climate change that we are already experiencing and fostering climate resilience. And then thirdly, it's climate finance. so providing financing for these climate mitigation adaptation actions. Now, the Paris Agreement is, of course, an international agreement with over 190 signatories. The US has been in and out. It sort of became a party in President Obama's administration. Then the US quit under President Trump's first administration, went back in under Biden, and I think we all know what's likely to happen going forward. But of course, with it being an international agreement, it's not binding on private stakeholders. However, the Paris Agreement and subsequent documents relating to it do recognize that it's not just countries, that it's got to be sort of cooperation of everyone, including private actors, and in particular financial services that have to play a role. So the private sector must participate in order to reach the scale of investments that are needed to affect this transition towards a low greenhouse gas emission economy and climate resilient development. So what role can insurers play? What part do they play, and how do they do it? Of course, traditionally it's been through providing insurance, and I don't have to explain to this audience how insurance works, but insurance, of course, only creates financial resilience. It has a number of limitations, which is that in relation to climate change risks, insurance is not available for chronic physical risks, so long-term temperature changes, sea level rises, coastal erosions. They're not insurable because they're sort of gradual changes that are already in process. Then insurance doesn't really, or traditional insurance, doesn't really help us with loss prevention. So it's sort of a reactive measure, paying compensation for when a loss has happened, but it's not really addressing the root causes of climate change, and it doesn't necessarily help with climate adaptation. Some people also argue that there's a moral hazard by continuing to provide insurance. People won't make changes. And perhaps most importantly, as we are seeing this increased frequency and severity of climate-related losses, this has a massive impact on insurability. There are already significant protection gaps in sort of various property lines and across several regions in the world. And it's because insurers just don't have the risk appetite, and they have to be mindful of their own financial stability. And so insurance is becoming first unaffordable, and but also increasingly unavailable. So the picture that is sort of emerging here is that insurance companies find themselves under lots of pressures and conflicting pressures in relation to climate action. So on the one end, there are regulators. They, of course, want insurers to manage risk prudently and to be mindful of their financial stability. Then on a political or societal level, there's pressure to close protection gaps. Here in the UK and also in the EU, there's a significant amount of political pressure for the insurance industry to be part of the energy transition. Policyholders, they want to have access to affordable insurance products on fair terms. And then, of course, shareholders, investors, they want to see their sort of returns on investment maximized. There are also rating agencies who are now not just giving ratings, financial ratings, but also ratings on ESG performance. And this sort of through ESG reporting, there's also increasingly sort of societal, regulatory, and also investor and consumer interest in the ESG performance of insurance companies. And all these different pressures can also sort of boil down into what's a concept called double materiality, which is an accounting concept from financial accounting, but which has now been adopted in various disclosure and reporting frameworks for non-financial reporting on climate and sustainability matters. So here we're looking at the inward impact. So it's the impact of climate change on the business, an insurance company. But at the same time, we're also looking at the outward impact, which is the impact an insurance company has on the environment or the climate. And this impact can be at entity level, but the impact can also be through its products and activities. And this is where my book picks up. So I'm putting forward my vision of insurers with a positive impact. So insurers as enablers of climate action and climate alignment to the Paris goals. So enabling policyholders and other actors in the value chain and in the wider community. So of enabling them to take climate action, to adopt climate change adaptation measures, build resilience, and also to contribute to climate finance with investments. So when I thought about the role of the insurance industry, I sort of, in my head, came up with this structure, trying to conceptualizing sort of different categories. And I'm going to use the terms green and brown as rather crude shorthand for climate action, green, and brown for sort of more harmful climate impacts. So insurance companies, they can start by looking at their own operations, and that's probably the easiest. It's here they've got the most control, and also in their own operations, insurance companies are actually not huge emitters. But then you should also look at what their business is at the liability side and the investment side. And then when you look at the liability side, I've sort of come up with different categories. So and on the sort of far left here, ensuring green, this is about transition insurance, providing insurance cover for green infrastructure projects, energy systems and technologies, which can really expedite carbon decarbonization, so the transition to a net zero or low carbon economy. And here, insurance is really important because it's a de-risking tool. So it's often almost a precondition to finance that a project in the build phase and in the operational phase has the benefit of insurance. Perhaps the most controversial category is not insuring brown. So this is limiting or withdrawing insurance cover from coal, oil, and gas projects. It is controversial, but I think everyone recognizes that this has to be done in an orderly way over a period of time, because in sort of this abrupt withdrawal would cause a lot of disruption and exacerbate transition risks. And then what I'm concerned with in today's lecture is greening insurance. So here I'm looking at using existing insurance products that we already know, but adapting them, developing them with green features, really to support policyholders to shift their behaviors and processes towards taking climate change mitigation and adaptation measures. And then also, of course, closely connected to providing insurance is also green risk management. So I will all be touching on that. So with greening insurance, this is concerned with product innovation, but in relation to products we already know, leveraging contractual relationships to shift policyholders' behaviors and processes towards taking climate action. So the enabling conception pictures the insurance industry as supporting policyholders. Green insurance products can incentivize policyholders to take measures, and insurers can assume and deliver an enabling role through the pre-contractual and contractual relationship between an insurer and its policyholders. So we're looking here at ex-ante and ex-post risk and loss reducing measures that can be implemented by the insured with the assistance of the insurer. However, in a variation to these of classic governance function of insurance, with my vision of the enabling role, the insurer does not just impose obligations for precautionary measures or penalties with premium increases or exclusions, but I'm really interested here in sort of nudge techniques which make the policyholder realize that it's in sort of their best interest, and crucially, the insurers support policyholders in implementing them, and ideally also incentivize or reward them for doing so. So here the insurance is not a means of sort of quasi-regulatory coercion, but more sort of paternalistic encouragement. So these green insurance products are not completely new types of cover, but they introduce green features and objectives to established insurance products. And in my book, I'm looking through this through the lens of the product cycle or the value chain, so from product development all the way through to claims management. So I won't say that much about product development and marketing because that's really specific to the UK and the EU, just to give you the highlights here. In the UK, when insurers develop or change new products or change existing products, they have to go to a certain product development and governance process and sort of consider various things. But currently, these requirements regarding product developments do not extend to a requirement to take into account any sustainability or environmental features as part of that product development. And then when we move to marketing, again, for general insurance products, there is currently no requirement to provide product information on their green features or any sort of sustainable objectives. In contrast, in the EU, there's already a move towards sort of integrating sustainability features into insurance product to a certain extent, but at the moment, this is limited to insurance-based investment products. So here in the EU, there's actually a positive obligation to consider sustainability features and to inform potential customers about those features, and even tell them that if the product doesn't have any such features, that it doesn't. But as I said, this is limited to insurance-based investment products. If you're interested in more information about this, I've got a nearly ready article about this, so do get in touch and I can give you more information. Then when we move on to the pre-contractual risk assessment and management stage, of course, policyholders have various duties in relation to the pre-contractual risk presentation. So under English law, consumer policyholders have a duty to take reasonable care to give accurate information to the insurer, information they're asked about, whereas business policyholders have a duty to make a fair presentation. So how would this extend to climate change risks and impacts? Well, if they are relevant to the risk, then for business policyholders, they should be part of the risk presentation. And so every now and then, the sort of question comes up, well, should all properties in the UK have flood performance certificates? they already have energy efficiency certificates, but with flood performance certificates, the concern has always been that it sort of plights property values for those properties that are in flood-prone areas. And also it hasn't really been sort of a burning issue in the UK because flood insurance is sort of bundled into normal sort of homeowner and property insurance. And there's also a scheme called Flood Re, which is sort of a state-organized insurance company that stands behind insurers that provide flood insurance. Then on the flip side of the coin, when we look at insurers and their pre-contractual risk assessment, here I think there's a real opportunity for early engagement. And this sort of pre-contractual dialogue could be used for discussion, so and sort of offering different levels of cover, or discussing potentially applicable exclusions, different level of premiums, deductibles, and limits, and really thereby sort of managing the risk attitudes of the prospective policyholder. And there's already sort of a real-life example, the insurance broker Marsh, for certain of their D&O cover products, they offer a pre-contractual ESG risk assessment. Then the policyholder is awarded the ESG rating, and this ESG rating could prompt the policyholder to choose pathways for mitigating ESG risks and also set targets for improving its ESG profile. Now, this is of course perhaps not feasible for small and medium-sized entities or consumers, where you don't have sort of tailored contracts, but you have standard terms. You also have less engagement, and also the cost of the risk assessment may outweigh the policy value. But here, perhaps sort of insurance distribution technologies could be used more effectively to offer risk assessments and modularized insurance cover that respond to risk levels. And again, there's sort of a nascent example, the Zurich Risk Advisor app, which is for corporate policyholders, but it enables them to carry out a self-risk assessment, on the basis of which the app then offers actionable risk management advice. And it also can connect the user to Zurich professionals who can do sort of a more in-depth assessment. Now, risk management advice is a really important part here, because there is a perception by many that climate change doesn't have an immediate consequence or impact that requires any action according to various pieces of research. But also there is what Michael Mann calls climate doomism. People thinking, oh, there's no point doing anything, it won't make any difference if I do something, but no one else does. But here I think insurance companies have a really important role to play for raising awareness and providing information recommendations. And this has in fact been one of the key recommendations in an OECD report on enhancing the insurance sector's contribution to climate adaptation. And again, there's an example, Munich Re. They offer a reporting tool for physical climate risk on Munich Re's location risk intelligence platform, so customers can identify and assess exposure to physical climate risk for their sites globally. Now, as to costs, citing here an article from your colleagues, Kenneth Abraham and Daniel Schwartz, there is sort of thinking that general loss reduction information is only likely to have a limited effect, because really policyholders, they may take on this information on board, but there are limited incentives to actually implement any of these recommendations. because they would entail incurring costs, and there's no sort of immediate financial benefit from taking them. Also on the risk side, by providing risk advice, there's of course a legal risk that insurers would incur liability for breach of a duty of care. And also to note, in the UK, there's a new consumer duty that all financial services providers owe to consumer customers. And again, you'd have to be careful to structure your advice around this duty. And also there are regulatory restrictions in the UK. There are restrictions on providing non-insurance business or services. Also incidental non-insurance services are okay. And I understand that there is a specific problem in the US, which is compliance with anti-rebate laws, which are applicable in some US states. But I have read, and I'm not sure whether this is correct, but the NAAC has advised that value-added products or services provided at no or reduced costs are not impermissible rebates, where they are primarily designed to provide loss mitigation or loss control or self-education about risks. Okay, then moving on to pricing. So pricing is a really important tool which signals risk and risk behaviors. So risk reflective premium pricing is also something that could be deployed in relation to coverage that entail climate risks, but there are also a number of issues with it. First of all, in the US, and I don't want to lecture you on US law, but as I understand it, there's various regulations to do with setting premium prices. And I read a very interesting article recently which showed or sort of tried to prove that actually that price regulation at state level can lead to premium cross-subsidizing from less heavily regulated states. So basically insurers try to make up premium in those states where it is less regulated. So now whilst premium discounts can incentivize climate mitigation adaptation measures, the insurers have to be mindful that at the end of the day, their premium income or the way they set premium is tied to the risks. Their premium income must be sufficient to cover technical provisions and the solvency capital requirements. And tying premium to risk is particularly challenging in relation to climate mitigation measures, because here it's sort of an attribution or causation matter. It's very difficult to translate into a risk loss or loss reduction, anything you do to reduce sort of greenhouse gas emissions. So reducing your greenhouse gas emissions may be good for the world long term, but it doesn't reduce your risk on anything in the next 12 months. So it's probably easier to establish a causal link between climate adaptation measures and loss reduction, because here you have a more direct connection between something you do to prevent or reduce loss and the risk, but it's still challenging to model it and to actually capture it in numbers. And this is challenging because there is sort of a value disconnect. So the sort of any discount you may give that may not even cover the costs of a climate adaptation measure. So for example, installing a flat door costs around 3,000 euros. So if the whole premium for your property per annum is only 4,000 euro, then you just don't have this amount to play with. And there's also a timing disconnect in that the loss reduction effect may not even sort of materialize or fully materialize and sort of annualized within sort of a 12 months policy period. So you may be the sort of good citizen insurer giving sort of a premium discount for investment in a flood prevention measure, but in 12 months' time, that policyholder may be insuring with somebody else, and so the next insurer would then benefit from the risk reduction measure. So what are the solutions? That's sort of difficult. So what's been discussed is to have longer policy periods to capture this risk reduction effect and allocate it to a particular insurer more effectively. But also there's ideas around participating insurer panels, so where you have a panel of subscribing insurers who all have schemes like this, or perhaps even something like a transferable bonus points scheme for loss reduction measures, similar to that of a no claims bonus for motor insurance. Then, so you can reduce premium. Then what about increasing premium for bad risks? Well, this has the downside that it can increase protection gaps and also exacerbate inequality in relation to affordable home insurance. And also in the UK, again, there's the consumer duty, and there would be issues around fair value requirements, which is the relationship between the overall price paid by the customer and the quality of the insurance products and its benefit and the overall costs to the insurer. So then moving on to policy wordings. So here what we've got to play with are deductibles and limits, exclusions, conditions and warranties, consent requirements, and nudge terms. Now, with deductibles and limits, again, they can create partial protection gaps. So it's a risk management tool, but to be used carefully. Then exclusions for climate harms. So one prominent example is one from the Lloyd's market, the climate change exclusion. But again, you are creating protection gaps, and the influencing effect of using an exclusion is non-existent if the matter at hand is something which is outside the control of the insured, if they can't do anything about it. Then using conditions and warranties requiring policyholders to take specific adaptation measures. So example, use of sandbags, valuables and documents must be stored safely if there's a flood warning. So again, they are useful tools, but they are more in line with insurance as governance. They can be coercive and have harsh consequences if they're not complied with. And again, in the UK, you have to be careful around the consumer duty and also unfair terms legislation. Now, what I'm really interested in is nudge terms, so terms that promote green behaviors and align processes to the energy transition at policyholder level. And here, there are already many examples from the health insurance where nudge terms are used to foster and promote good behaviors. For example, providing gym memberships or giving bonus points that lead to certain rewards that are also connected with health benefits. And so one example of a nudge term I wanted to show you in more detail is the Nordic Marine Insurance Plan 2013, but amended last year. So the Nordic Marine Insurance Plan are these standard terms and conditions used for marine insurance in the Nordic countries. And last year, they introduced a clause which finds applications in instances where vessels have been damaged and need to be repaired. So the usual procedure is that the ship owner would then get various cost estimates for insurers, and insurers would approve the lowest cost estimate for the repair of a vessel in a shipyard. Now, under the Nordic Marine Insurance Plan, it's not just the cheapest tender or cost estimate. The Nordic Insurance Plan actually asks the parties to take into account the fuel consumption that is needed from the damaged ship to go to a shipyard. So it's not necessarily the cheapest shipyard which should be chosen, but it may be one that is closer, because then you travel less and you use less fuel and your emissions are lower. And also, it's not just the distance of the shipyard, but also the commentary says that you should be taken into account the ESG standards of the relevant shipyard. So this is a really good example of a nudge term. Then when it comes to claims management, I think this is one of the key areas where the insurance product cycle could be greened. Here is the idea of building back better. Also, somebody told me you're not allowed to say that in the insurance industry because it triggers notions of betterment. So you're supposed to call it build back more resiliently or build back more sustainably. And it's really the idea to rebuild to agreed environmental standards, often higher standards than before, and also according to sort of land use regulations. The means of doing though could be a green reinstatement or green replacement clause, and it could mean that the loss paid out by the insurer is actually higher than the actual loss, because you would be complying with these additional standards. And build back more resiliently, build back more sustainably would also entail or could entail using ESG compliant service providers and suppliers. There's a whole raft of legal principles that could potentially be engaged. The indemnity principle, so principles relating to valued policies, reinstatement, betterment, soon labor, and subrogation. So the fallback position is on claims, that claims are settled in cash. So under English law, you would actually need a reinstatement clause, a clause which says that the basis of settlement allows for reinstatement. And here you would have different drafting options. You could look at whether there's a reinstatement as an alternative to cash settlement, then which party has the right to elect. Is the clause only offering some plain vanilla reinstatement or green reinstatement? To which insured assets should green reinstatement apply? What sort of measures or standards are applicable? And really important would be to consider the allocation of costs, because sustainable reinstatement can be more expensive, the materials themselves, but also the building costs. And here the sort of things that could be considered is the doctrine of betterment, which applies where the insured derives a real pecuniary advantage from reinstatement, but it doesn't actually apply under English law, where the rebuilding is the betterment is only incidental or unavoidable, sort of an unavoidable result of improvements. and the burden there is on the burden of proof is on the insurer. So again, one would have to think about drafting options, about costs, and really this is also an area where one could think about whether any government grants or subsidies are available. So they could be considered as amounts reducing the loss, and if they are such amounts, then credit should be given by way of subrogation. We had a case here in England recently to do with subsidies granted in relation to restaurant closures during the COVID crisis. And the insurer's argument was that when they were paying out claims for business interruption losses, credit should be given for these government subsidies, and the court agreed with them. So here one could perhaps anticipate that in the policy wording by including express clawbacks. Also for consideration could be whether there's perhaps a modular approach to reinstatement for additional premium, but then the question is, would policyholders choose it? And of course, using suppliers and service providers that are subscribing or using sustainable practices. And I already mentioned the Nordic Marine Insurance Plan. Here's an example, and I must give credit for the graphic to Allianz, the German insurer. And they calculated the costs and the greenhouse gas emissions generated if the windscreen of a Volkswagen is replaced rather than repaired. And it is in German, but on the costs it says if you're repairing rather than replacing, you can reduce your costs by 87%. And even better, repairing the windscreen versus replacing it, you're reducing your emissions by 99%. So you can see how green or how reinstatement or rather replacement could be a sort of much better way. And there's a lot of buzz around the circular economy in Europe. But you also have to be mindful whether you would meet policyholders' expectations. Policyholders may feel a little bit, put out if their windscreen is repaired rather than replaced, and you still have a little scratch maybe on your windscreen. So you'd have to manage these expectations and perhaps also think about addressing how the policyholder may not be fully compensated. And now closing the circle of the policy life cycle, one piece I'm really interested in, and it does sound like an insurance heresy, is advance payments for loss prevention. So insurance not indemnifying for losses actually incurred, but giving advance payments which are utilized to reduce the risk of loss. There are sort of little micro insurance examples. One I know of is in Fiji, where there's a sort of insurance scheme, a community-based insurance scheme, which pays out, or part of the payment is made in advance when there's a cyclone warning, a cyclone is imminent. And this money is supposed to be used, and I think it's sort of partly paid out in vouchers for people to go out and buy food supplies and hardware to secure their property. And this really is sort of based on this idea that prevention is better than cure. And it's sort of a principle that's recognized in healthcare, but I think it could also have application in insurance, where a risk prevention measure may be a lot less expensive than paying ex post for a claim. There's been some research from the US Chamber of Commerce recently, which found that each dollar of investment in resilience and disaster preparedness reduces a community's economic costs after an event by $7. And this also could help with tackling insurability issues and protection gaps. Now, just very briefly touching on some of the theoretical frameworks around insurers as enablers. So I've been looking at stakeholder capitalism. So this is a concept which sees companies at not just serving its shareholders, but other stakeholders sort of around it, like employees, customers, suppliers, local communities, and also society at large. And it's really looking at the interests of all these stakeholders because there's a shared commitment to certain sort of policies and decisions, which will strengthen the prosperity of the company in the long term. There are also various corporate social responsibility theories around companies not just making money, but also embrace other responsibilities to society. A big theme in the UK is investor stewardship, using your power as an investor to influence the investee company in a positive way. And sort of coming back to the governance conception, so thinking of insurance as quasi-regulator controlling, I'd really like to see this reframed in a sort of more positive way as insurers as enablers. But really the one conundrum I kept hitting in my research is how this enabling role can be consistent with what we call in UK corporate governance the corporate purpose, the idea of shareholder primacy. When the enabling costs money and diverts resources that would otherwise be profits. So if money talks, the question is there a business case for insurers as enablers, or do we need legal duties to push it through? And there are already sort of a raft of sort of guidances and sort of industry frameworks around companies and also more specifically insurers playing their part in relation to climate action, but they're not binding, and their nature is sort of guidance. But there are sort of a few indications that we may be moving towards more substantive legal duties, both within the EU space. In the EU, there's the Corporate Sustainability Due Diligence Directive, which actually imposes on companies above a certain size to identify, bring to an end, prevent and mitigate, and account for adverse human rights impacts and environmental impacts, not just in their own operations, but also amongst their subsidiaries and in their business relationships and their value chains. Now for insurers, these due diligence obligations don't apply yet in relation to their downstream market, only upstream. But what is worth noting is that the CSDDD, this is sort of the acronym for this directive, is that it also applies to non-EU companies if they have a net turnover of 450 million euros in the EU. So it could apply to a British company and it could apply to an American company. And then hot off the press, a decision by the Dutch Court of Appeal from last week, Milieudefensie and Shell, where Shell won the case, but the court was very clear, saying that corporate actors have a duty of care under Dutch law to contribute to the mitigation of dangerous climate change by reducing their emissions, and not just in scope 1 and 2, but also in scope 3. And this is a matter of human rights law. But they also recognized that companies it's sort of similar to the business judgment rules. Companies are free to choose their own approach, how they are going to reduce their emissions, as long as it's consistent with the Paris Agreement climate targets. So then, why should insurers be enablers of climate action? Well, beside sort of the societal pressure is their business case, but I think ultimately the business case will be the existential threat of climate change and sort of physical climate risk and climate change litigation, and sort of the societal pressure that comes with it, that will become the business case. And this recently noted in a PwC report that insurance companies must come up with climate solutions and engage with climate action to re-engender trust, but also to build and maintain relevance. Because if all they're doing is reacting with increasing premium and withdrawing from the market and imposing exclusions, then ultimately they're sort of chipping away on their own business case, and it will undermine their sort of market segment sort of eventually. So strategically, they do need to have transition plans, and they do need to engage with climate actions. What I haven't had time to touch upon now is that, of course, insurance companies can't just do this on their own. They have to cooperate amongst themselves, subject to sort of antitrust regulations, but also they have to do it in partnership with the public sector. So analogous to blended finance, insurers have to work with governments to close these protection gaps and to enhance resilience. They also need to work with communities. And I do think sort of an often sort of overlooked element is that mortgage lenders who are sort of stakeholders who benefit from insurance on homes and businesses, that they should also be part of the discussion. And of course, it's also important to have sort of the right legal and regulatory framework with consistent but also long-term policies, regulatory certainty, and something that is perhaps a distant dream right now, international alignment. And with that, you'll be pleased to know I'm coming to an end. I can pass my slides to Travis, and perhaps they can be circulated. There's a whole list of things you can look at. And so I think I'm done, and I'm happy to take questions.
Well, great, thank you. So we have a few minutes for questions. I have one, or I have several, but if anyone else, I don't want to hog the mic. So if anyone else would like to ask one, raise your hand, or send me a chat. So, all right, I'll ask the first one then. So in the US, at least, and at least especially in the legal academy, there's been this sort of received wisdom from the law and economics perspective that trying to do things like address climate change through mechanisms other than the tax system is just going to be inefficient. It's just going to distort incentives in a way that creates inefficiencies. And so for things like this, we really ought to just tax and then let private insurance markets operate as they may. Obviously, that's a massive oversimplification, and there's a lot of things that misses.
Mm.
But I'm wondering whether you see anything special about insurance that makes it better suited to address climate change than the normal tools of regulation like tax or just straightforward environmental regulation. And I'm thinking in particular, there's an article by Kyle Logan, Ronan, and Abraham that make this argument with
Mm.
regard to the example they use, I think, is in health insurance. But
Yes,
do
yeah.
you, so is there anything special about insurance, or is it more, or is your interest in this more grounded in the idea that, look, belt and suspenders, we should just try to address
Mm.
climate change however we can across all the different
Yeah, I
angles?
would argue there is something special about climate change, which is that it is a global emergency and that the normal regulatory tools that you would use, they're not being deployed fast enough. So yes, you could do it with taxation. You could probably also do a fair amount through adjusting regulatory capital, and the EU is looking into this. But these measures are just not coming fast enough. And this is why I think corporate actors do have a responsibility to engage. And for insurance companies particularly, I think there's also something special in that that you have almost like a sort of more of an alignment of interests in reducing losses and in enhancing resilience to climate change.
Great. Peter?
Actually, there's a really interesting question from Marcos Orofino in the chat. So why don't
Okay.
Marcos, or should I just read it? Here's what he says. Regarding prepayment for loss prevention, do you identify any potential legal issues that could arise, considering that in its traditional conception, an insurance contract is meant to compensate for losses that have already occurred? Thank you, he says. So.
Yes, absolutely. It is as I said, it is an insurance heresy to contemplate making advance payments. However, it's perhaps not so far out. If you think about doctrines like the principle of sole labor in marine insurance law, where the law actually recognizes that the insured should incur costs and expand labor and do things in order to mitigate impending or operating losses, and that the insurer would then not just compensate for actual losses, but also for these costs incurred in suing and laboring. Now, it's sort of stretching this to advance payments of losses is a big stretch because here you don't have the same imminence of an sort of acute loss. So you don't have the same nexus. But I do think there is perhaps sort of it's time for sort of a gear shift, or for thinking about insurance differently. And of course, the indemnity element is always going to be the most important one, but doing it in combination to have an element of pre-finance which is applied to a loss reduction measure in combination with indemnity insurance. And this is perhaps easier to apply on sort of community insurance schemes where you have greater control over specific projects that sort of aimed at risk reduction. So it's a concept, but I acknowledge that it's difficult to implement, and there would be quite a few legal challenges.
Mark Myerson had a comment in the chat in response to that, saying that in the U.S., courts rejected using sue and labor as the basis for paying for Y2K conversion costs. So I take that for what it's worth.
Thank you.
So if we have time, I have a quick question just about that Nordic marine insurance policy, which I thought was absolutely fascinating. First of all, I just wondered how you got it or found out about it. Is this typical? And what made them want to do that? Was it like, yeah, just what's the backstory there? Was that just a sort of purely profit maximizing calculation that we should force these guys to go to greener repair facilities, or was it under pressure from activists, or is there any more you can tell us about that?
About the background of the change, who's
Yeah.
of the behind it, that I confess I don't know. I came across by pure coincidence, looking at just sort of comparing marine standard terms, and I don't know the backstory, but I think it's such an interesting example of nudging. So and it also seems one where sort of both parties benefit from it. So it's not hugely burdening one party in order to achieve something. So I think it's a brilliant example.
Thank you.
Okay, I think we have maybe time for one more question.
Nope.
Or none? Okay, well, thank you, Franziska, for joining us, especially all the way from London at this late hour. And please do send me your slides, and we'll make them available. And hope to see you again soon, and hope to see everyone again in 2 weeks for our final session this semester.
Thank you so much. Thank you.
Okay.
Bye.
Thanks,
Bye.
Franziska.
Bye.
Bye.
Bye. Bye.
Bye. Bye, everybody.